Okay, hello everybody. So in this video, we're going to look at PFF Outcome 2. And first of all, we're going to look at the first question. But maybe we'll just look at the actual question itself first of all. So we've got this information here. There's a company that's making a component. Oh, sorry, it's making 4 components. And using these 4 components, we've got to calculate, using the information about the sales volume and the sales price, material A, material B, that's used to make each of these 4 components, and the labour hours and the labour rate, and the variable overhead and direct expenses. We've got to work out the total profit from making all of these. So if we make all of these, what will the total profit be? Then we compare it to the supplier price, and we've got to see whether or not we would make or buy each component. So what we're required to do is calculate the total current profit for the total budgeted profit for the business, showing total variable cost, total marginal cost, total contribution, and the variable cost and the marginal cost per unit. Then state advice as to whether we would make or buy each component. So to calculate profit, it's going to be sales, take away total costs. So this section here is the question. I'll put the question in light grey. Then this here is the solution in this box here. You don't have to put your solution in boxes. I've just put it here to make it easy to organise. So basically we're doing sales, take away total costs equals profit. But we're going to separate the costs into categories. So we'll separate them into the variable costs and then fixed costs, and then direct expenses, which is kind of like a semi-variable cost. So first thing is calculate the sales revenue for each component. So the first one is look at each of the 4 components. So Balzac, Hugo, Voltaire, and Zola. We've got these 4 components. First thing we'll do is work out the sales revenue for each of them. We also have another column here for the total. So we've got 4 columns, one for each component, then a final column, which is the total, which basically just adds up the total value to the company for each of these 4 components. So first one is to calculate sales revenue. So for Balzac, we've got the quantity, which is 1,000 that were sold, or the volume. And we've sold them at £120 per unit. So the sales revenue is going to be 1,000 times £120, which will be £120,000. Then for Hugo, it's going to be the same thing. It's going to be the sales volume. The volume of sold is 4,000. We've sold them at £100 per unit. So the sales revenue is going to be 4,000 times 100, which is 4,000. I keep going like that along here, just multiplying the price and the volume, or the price and the quantity, and I get the sales revenue for each of these components. I then get the total sales revenue generated for the firm Rousseau & Co., which is 120,000 plus 400,000 plus a million plus 175,000. So I've just added these together, and that'll give me 1,695,000. Then move on and calculate the variable costs. The variable costs will be the material costs, the labour hour rate, and the variable overhead. So the material cost is going to be the price per kilogram and the number of kilograms per unit. So it's £1 per kilogram, 2 kilograms in each unit, and there's 1,000 units. So the total cost is 1 for Balzac is 1 times 2 times 1,000, which will give me £2,000. For Hugo, it's going to be £4 times 4 kilograms times 4,000 units, which is going to give me £64,000, which will be the total material cost of B for Hugo. Same idea for Voltaire and Zola, multiplying the volume by the kilograms per unit by the price per kilogram, and we get the total cost of material for each of the components. So we've got the total cost of material for A for each of the components. We get the total material cost of A for the company by adding up the material cost of A for Balzac and Hugo and Voltaire and Zola, which in this case would be 2,000 plus 64,000 plus 90,000 plus 45,000, which will give me the 201,000. Exact same idea for B, except this time we're multiplying it by the kilograms per unit in B and the price per kilogram of B by the volume. So same deal along here. For the labour cost, it's going to be the hours per unit times the labour rate per hour. So we can see to make 1 unit of Balzac, it's going to be £10 per hour times 3 units, i.e. 3 hours per unit. So it's going to be £30 per unit multiplied by 1,000 units is going to mean I've got a £30,000. Same with Hugo, it's going to be 4 hours per unit times £12 per hour times 4,000 units is going to give me 192,000. Same idea with Voltaire and Zola, just the volume times the units, the labour hours per unit times the labour rate will give me the total labour cost for Zola. And again, to get the total labour cost of the company, add all these numbers up. Variable cost, the total variable overhead is going to be the sales volume times the overhead per unit. So it'll be 1,000 times 6, which in this case will be 6,000 for a Balzac. For Hugo, it's going to be 4,000 times 12, and so on all the way along. Just the overhead per unit times the number of units. Then to get the total, I'm just adding these together, so 6,000 plus the 48,000 all the way along, which gives me the total variable overhead of 91,500. We then want to get the total variable cost, which is all the variable costs added together. So for Balzac, that will be material cost of A of 2,000 plus material cost B of 25,000 plus the labour cost of 30,000 plus the variable overhead of 6,000, which will give me 63,000. And it's the same for the total variable cost of Hugo and the total variable cost of Voltaire and the total variable cost of Zola. So we get all the total variable costs, then we add them to get the total variable cost for the company, which is, we can do it two ways. Either add these across this way or add these down this way. It should be the same number, which will be £1,038,250. To get to the total marginal cost, we have to add on direct expenses to the total variable cost. Direct expenses, it's one-off expenses for the use of a machine. So we rent a machine out, which means for Balzac it will be £10,000 for a machine. It's a semi-variable cost in the sense it can be avoided if we don't purchase, if we choose to buy in Balzac and not manufacture Balzac, we can avoid the 10,000, but it doesn't vary with the quantity. So it's not exactly fixed in the sense we can avoid it, and it's not exactly variable in the sense that it doesn't vary with the number of units we produce. So we can produce a lot of units or a few units, we still have to pay the 10,000. So it's £10,000 that we've got a direct expense for Balzac. So to get the total marginal cost, it's going to be 63,000 plus the direct expense of 10,000 is giving me 73,000 is the total marginal cost. I can see the direct expense for Hugo is 2,500. So put the 2,500 in here. The total marginal cost then is the total variable cost for Hugo, which is 384,000 plus the direct expense of 2,500, which will give me 386,500. And again, I go like this all the way along to calculate the total marginal cost. I then get the total marginal cost for the company by adding up the total marginal cost for each of the individual components, which will give me 1,081,250. Next thing I want to do is calculate contribution. So the contribution is going to be the sales revenue minus the total marginal cost. So for Balzac, that will be 120,000, take away 73,000, which will give me 47,000. For Hugo, it's going to be 400,000, take away 386,500, which will give me 13,500. And I keep going along like this by doing the sales revenue, take away the total marginal cost, and I get the contribution for each of the components. Then I get the total contribution for the firm, by adding up all the contributions for each of the individual components, which should give me a 613,750 pounds, which again is just all the contributions added up. Another way to do it is to do the total sales revenue, take away the total marginal cost, which will give me the total contribution. Final thing to get the profit is to do the contribution, take away the fixed costs. The fixed costs we see at the bottom here in the question are £80,000. So we get the total contribution, which is sales, take away marginal cost. Then we take off the contribution of 80,000. So we've done £613,750. Take away 80,000 is going to give me £533,750. And that's just calculated the total budgeted profit, clearly showing total variable cost, total marginal cost, total contribution as well. The next part though we've got to do is calculate variable cost per unit and the current marginal cost per unit for each component, then state advice as to whether or not we would make or buy. So to get the variable cost per unit, we just get the variable cost and divide it by the number of units. So we can see here the total variable cost of Balzac is £63,000 and the number of units is 1,000. So the total variable cost is going to be 63,000 divided by 1,000, which is £63. Also have to calculate the marginal cost, the marginal cost per unit for each component. So for this company, for Balzac, it's going to be 73,000 divided by 1,000. 73,000, the total marginal cost. The number of units is 1,000. So the marginal cost per unit is 73,000 divided by 1,000, which is £73. We've then got to make a make or buy decision. And we make the make or buy decision by comparing these two here, which is the marginal cost per unit compared to the supplier price per unit. So the marginal cost per unit is all the costs we can avoid by not making the component. So we still have to pay the 80,000 fixed costs, but we can avoid all the variable costs and the direct expenses if we just buy the component in instead. So we can see the marginal cost per unit is £73. There is a supplier who's willing to supply Balzac and he's willing to charge £75 an hour. So if we've got offered to us a £73 an hour, if we can manufacture ourselves for if we make the component for £73, or we can buy it in for £75, obviously the cheaper option is to make the component ourselves because it only cost us £73 to make it, whereas it would have cost £75 to buy it, which means we should make this component. So I've got to make buy options here. Let's see if the first one we're going to make. The next one, I've done the same thing to get the variable cost per unit. We're going to use the variable cost per unit later, so make sure we calculate these here. But the ones that are going to force the decision are going to be the marginal cost versus the supplier price per unit. Again, it's the same thing I've done here with Hugo. I've got the total marginal cost is 386,500. I divided that by the 4,000 units, which gives me a marginal cost per unit of £96.63. That compares to a supplier offer price for Hugo of £90. So we can either spend £96.63 manufacturing the component, or we can buy it for £90. Obviously, we prefer the lower cost option of £90. So in this case, we would buy the component. Just going like this way all along for Voltaire and Zola, and we'll end up with the decisions. Make a Balzac, buy in Hugo, buy in Voltaire, and make Zola. So that's pretty much us answered the first part of the question then. We've got A at the road, and we've got the total profit, and we've made the make buy decisions for the company there.